retail banks and the financial institutions, they get the cash, effectively. So what they find is their deposits go up. Now, what's the fancy term to describe the amount of money circulating in the money system, in the money markets? Liquidity. Yeah, so we would say that the liquidity in the banking system increases as a consequence. So RBs, so it's retail banks, deposits, they go up. So liquidity in the banking system goes up. Now, very liquid assets. What's the most liquid asset, Alana? Cash. So actual cash is the most liquid asset. Because if I was to ask you, Jonathan, because you mentioned the word liquidity, so define liquidity.
How easy it is for them to provide cash.
Yeah, liquidity is the speed and the certainty with which you can turn an asset into cash. That's what liquidity is. Speed and certainty with which an asset cash being the most liquid, obviously, because it's already cash. Okay, can you give me another example of something the bank might hold which would be a little bit less liquid? Gold. Okay. Nice, in unison, yeah. Gold, yeah.
Property.
Mortgage, do you mean like the mortgage book, maybe?
Yeah.
Right, yeah. No, that might not be, some of that might be a bit toxic, mightn't it? So you might not be able to sell off all your loan book.
Yeah.
Especially if you've got a property bubble which has just collapsed, but yeah, okay. So liquidity is the speed and so. Now the other thing is cash, liquid assets. Do they earn the bank much money? Because banks are privately owned, profit-seeking enterprises, or they were before the Great Recession, before the government took big stakes in them. But you know, we want to get them back to private ownership, making profits. So what then will the retail banks want to do with these deposits? They don't want to sit on it. Right, exactly. So the other intention is the central bank buying these bonds, increase liquidity in the banking system, and then the hope and the expectation is that the banks will then make loans. And they'll make loans to firms to invest in machines and expansion. They'll make loans to householders to buy new houses, buy new cars. And all of that should do what to economic activity? Right, it should increase it. That's the theory, at least. So the retail banks, these deposits, they need to then issue new loans. And that then leads to an increase in economic activity, or so the theory goes. Now, Ellie, if I was to say to you, well, evaluate that point after the Great Recession. So the banks are sitting on all this new money, this new lovely cash. Why were they not able to issue loans? No, they did. They had the cash because they had the new deposits. Hmm? Nobody wanted the loan because? Why not? Right, okay. So uncertainty meant that firms, they thought, well, it's a bit risky, isn't it? We've just, the back of the Great Recession, you want me to take a 250,000 loan for X piece of equipment when I might not be able to sell my goods? No chance. So they were very wary. Why would Megan households have been very wary?
Because they might not be earning as much.
Right. They might, or worst case, might have lost their jobs. Therefore, the last thing they want to do is take on another loan. More their preference would be any loans they have, pay down their debt. So actually what banks found was that people were saving more, they were paying down their debts more. The last thing they wanted to do was take on new loans. So this is all very well in theory, but as you know, in reality, theory and reality in economics, they oftentimes do not play out as you would think in the textbook. So that was short-lived. That didn't actually happen because of the reasons we've just discussed. And then the third reason is to do with what happens to the price of the bond when the central bank is buying them all. Right? So the demand for bonds rockets. And you could, of course, do your simple supply-demand diagram for that. What then happens to the price of the bonds? Increases. And here's the key, here's the crux of it. What happens to the yield, the coupon payment? It decreases because we know there is an inverse relationship between the bond price and the yield, correct? So the price of the bond rises, that then leads to a fall in the yield. Right, now, let's then imagine that you're a wealth manager. You're Gareth Johnson from Brew and Dolphin. And your job is to make money for your clients who give you money to invest on their behalf. And you, maybe for years, you've been buying government bonds because it's a nice safe bet and a nice little earner in return. Will you want to buy government bonds? Alana's shaking her head here already. Will you want to buy government bonds when the yield is falling?
No, because I need to get less
Right.
money.
It's no longer a very competitive return. So what are you going to do as a fund manager?
Get rid of them all.
No.
Sell them and then reinvest.
Okay, well, you could, so you'll hold on to what you've got. But moving forward from the point at which QE takes place, what will you do? You will no longer seek out government bonds to make a return. What will you seek out? Where might you as a fund manager put your money? Stocks and shares, yes.
Isn't that volatile as well, in general, especially after a recession?
Well, the general trend in the FTSE is always up. Trend growth. And because it's a bit riskier, you get a bit of a higher return or reward on it. Yeah. And I remember being at the Target 2.0 Bank of England competition at the what's that hotel? The Copthorne in Newcastle one year. And one of the questions that the 4 panelists put to the Emmanuel College students was, what's a sign of successful QE? And a sign of successful QE is actually a rising FTSE, because the demand for stocks and shares goes up. So if quantitative easing is successful, you should see a rise in the FTSE. But obviously you need to know why that's the case. And why is that the case, Ellie? Because you as a fund manager and seeking out, because they will bring you higher returns, correct. So fund managers, what are they going to do? They're going to seek higher rewards, higher returns. Government bonds are no longer longer any profitable money makers. And so where do they look? They look to the FTSE, they look to the stock market. And so there's an increase in the demand for stocks. And that's simply by default, it's demand and supply. That then pushes up the value of the FTSE, the index rises.
So what would that do to the wider economy?
Okay, so what would that do to the wider economy? So when you are buying stocks, and so say you and I, we all bought, I don't know, £100,000 worth of stock in Tesco PLC, Public Limited Company. Public Limited meaning?
Owned by stock.
Public Limited meaning who can buy the stock?
The public.
Anyone. Right, so what's the difference between that and private limited company?
Only certain kind of investor groups, and they've got to be approved.
Only friends and family, usually, yeah. Okay, so we put £100,000 of stock. We buy £100,000 of Tesco stock. Now let's say that their share capital is £400,000 and we've bought 100,000. So what have we bought effectively?
25%.
Right, so we've bought a percentage of that company. We've bought 25% of it, 1 over 4. We've bought a quarter of it, we've bought 25%. But also, if let's say Alana then is the managing director of Tesco, what does she now have?
More money.
She's got £100,000 extra. So what might you then do with that 100,000 as CEO of Tesco?
Expand the company.
Okay, so you might expand. So you might then have to build a new, I don't know, warehouse. That'll create jobs. That'll create employment. What might you do to your stores?
Expand.
Right, or revamp them, or I don't know, start new lines, or whatever it might be. But all of this, effectively what you're doing when you buy shares, you're lending companies money. And because you're lending them money, that then generates economic activity. So we talk about loans here, and banks making loans. But actually, when you are buying stocks and shares, you're effectively lending them money. And you hope that they make that money work because you're wanting a good return on it.
Is
Yeah.
the price of stocks and shares perfectly elastic? Or not perfectly inelastic?
No, I mean, shares rise and fall, don't they, all the time?
Yeah. But like, you can create an infinite number of shares, can't you? Like, there's not a certain cap on shares.
No, but of course, the more you issue, the more you're diluting.
Yeah.
Would it be better
Hang on, so fund managers seek higher returns, increase the demand for stocks. And then, so you need to make a note of what you're effectively doing is you're lending money to PLCs, public limited companies, and then they can expand, they can recruit, and all of these things will generate more economic activity. Now, what group or groups in society tend to have enough money, stuffed under the sofa that they can buy lots of stocks and shares? Right. Okay. It's people with fairly good jobs and stable incomes and all that sort of thing. And so again, one of the criticisms of this would be this action by the central bank is actually promoting and actually maybe even exacerbating, trying to get that word amalgamation in, but maybe even exacerbating the problem of equity, because when the central bank does this, ultimately who's going to win? It's the people who've got plenty of money around already, who can afford to invest lots of money in stocks and shares. And so you're widening that inequality gap, sorry.
Isn't it about, on capital investments, isn't it about 5.3% per year? on their income each year.
In,
So they
what do you mean by?
like,
Do you mean
people that-
returns?
Yeah.
I couldn't quote those figures off the top of my head. I'm not sure. What's your source on that? Where?
I tutor.
What?
I tutor.
Right. I'd need to double check that. I don't know. So it's a much broader policy than just let's dump a load of money in the banks, with much wider ramifications than just, oh, the banks have more money to lend, crack on with it.
So would the,
You're looking at exchange rates, you're looking at lending by retail banks, you're looking at investment by fund managers.
so would the stocks and shares be the most significant?
Yes. So this one here is probably the more effective kind of, what would you say, consequence really of the policy.
Especially one like trapped in liquidity trap.
Exactly. Yeah. Good point. Yeah. When we're trapped. So the amalgamation of these three consequences together, hopefully they might then help to dig the economy out of a great recession. Okay, so if you get asked something about QE, you need to make sure that, yes, this is important, but these other two, and especially this one, that kind of understanding of the diversion of funds into stocks is a very, very important one, often missed.
Would an evaluation be that people might go into other areas around stocks and shares like art or other?
Yeah, and another really important point is government bonds are really, really safe bets. And FTSE 100 stocks and shares, they're really safe bets as well. But if you found that you as a fund manager, you're not making enough money on these relatively safe investments, what does that then push you into? More risky investments. And whose money are you risking? You as the fund manager, whose money is it? Is it your own? It's your client's money. And so that then puts your client at an even bigger risk, because it's that old moral hazard thing, isn't it? I'm not pointing at you, Ellie. But you, as in you, the fund manager, you're not that bothered because it's not your money, and it's much easier to take a bigger punt with someone else's money, as I'm sure you know, than if it was your own money. If it was your own money, you'd think twice, you'd think thrice, you'd think more than that, wouldn't you? So it also forces, it might force fund managers into, say, putting money into Greek bonds or Greek debt. Because the return on Greek debt's about 22%. Whoa, happy days.
But they're not very good at it.
But exactly, the likelihood of you actually seeing that money back again, sorry to any Greek viewers, but I'm quite big in Greece. What?
The same percentage of getting it back.
Yeah, well, maybe.